If you are a smart money trader or an ICT trader, you probably would have heard of fair value gaps. But what I'm about to show you may well be the best kept secret in FVG trading. If you keep watching until the end, I'm going to show you how to trade it live in the markets successfully. Hi and welcome back to the How to Trade YouTube channel. My name is Connor Woods, one of the trading coaches here. And today you're going to learn all about inverse fair value gaps. Now FVGs are an integral part of my trading and the smart money concepts world. What is truly great about them is that it can be used in a variety of different ways, and in today's video I'm going to show you another one of those varieties. So let's get started. Now then, fair value gaps, or FVGs for short, are an extremely simple but powerful concept to grasp. Now some call it imbalance, inefficiency, liquidity voids. You can call it anything you like really, but what does it actually do and what's it all about? Well, an imbalance of orders is when a market exchange receives more kind of one order, i.e. buy or sell, over the other, and not enough then of the opposite side of the order, so maybe more buyers than sellers or more sellers than buyers. Now you've got to think, for sellers to complete their trades, there must be buyers on the other end. And for buyers to complete their trades, there must be sellers on the other end. That's how the markets work. But sometimes we get this equation slanted heavily in one direction. That creates an imbalance in the market, which is also known as a fair value gap. And often this gap is then filled as price becomes balanced again. Now, extreme cases of order imbalances may cause suspension of trading until that imbalance is resolved, but typically the ones that we trade are the less severe versions, shall we say. Let's show you exactly what I mean theoretically now. Now, with this in mind, typically this is what it will look like on your charts. So here's just a theoretical example of the price moving in a bullish trend. As you can see, the price moving higher. Now, during that move, we sometimes see quite an impulsive move to the upside within that move. So we see quite a sharp move. Now within that sharp move, that's when we start to see those imbalances occur between the buyers and the sellers, and that's where we get our fair value gap created. Exactly the same for the bearish example. So you see the prices moving lower. During that bearish move, we had a really sharp impulsive move lower. We got that imbalance between buyers and sellers once more, and a little fair value gap was created. I'm going to show you exactly how you measure that on the chart later on in the video, but let's take a look at some examples of when they could occur. And normally we can use these fair value gaps as a support and resistance area or a target for the price. But sometimes there'll be a situation where the price will simply run straight through that fair value gap. Then what do? And that is where inverse fair value gaps come in. So let's go back to that bullish example. So let's say, for example, the price didn't bounce off that initial green line where the fair value gap is, but the price traded all the way through. What was previously a support area can now be used as a resistance area to go in the opposite direction, just like this. Exactly the same for the bearish example. You see that fair value gap previously. Normally we can see a reaction and it be used as a resistance area. However, in this occasion, the price went straight through the fair value gap, and then that previous resistance is now a support area, which is our inverse fair value gap, and we trade it in the opposite direction than what we originally thought. Okay, so let's have a look at a live trading demonstration now. So the first thing really we're looking for is a market which is moving in the particular direction in an impulsive manner, because then we can mark our fair value gaps. So if we just look at the current situation here on USD versus the Swiss franc, I literally pulled this chart out at random. You can see that we've got a fair value gap here. So we mark that as a fair value gap. Now normally with fair value gaps, what we can look to do is we can use them as a target for prices, or we can use them as a support or resistance area. This is a bearish fair value gap, so we'll be looking for this to be a resistance area. So if we let the market play through, what you can see happens is initially we get a nice retest basically of this fair value gap, and it acts as a nice resistance area. So if I mark a short position there, you may have looked for something like this, and you would have reached 1.2 to 1 risk reward. So if I let that trade play out, you can see what happens is the market reaches about 1.2 to 1, but then reverses depending on what your risk management plan was, whether you were stopped out at entry. But the market either way comes up and starts to fill that fair value gap. And that's when we need to be on alert. So when the market starts to fill the fair value gap, we can use it as the opposite. So what was previous resistance, we can use as support. We use the inverse method. So once we let the market play out a little bit here, you can see what happens is the market doesn't quite break above it just yet, but it's hovering around it. So we've still got our eyes on this. And really what we're waiting for is that really key candle breakout. There it is. See that? What happens is the market, it does fill the fair value gap. And you could argue this is a bit of a breakout candle. But this is a clean, bullish engulfing candle, which, you know, was a breakout above the fair value gap. That was the most convincing one that we've seen. So this fair value gap now becomes an inverse fair value gap. In other words, it was resistance and now we can use it as support. So if we look to go long with a stop loss at the end of that inverse fair value gap, and we look to try and play this market higher, let's have a look what happens. You can see how we've now got that breakout, and this really starts to take, this trend starts to take a new shape. You can see we start to create higher highs, there's a higher low, and again we're breaking higher and higher and higher, and actually this market goes on to, you know, really surge higher and create a new trend. But more importantly, we managed to get a 4 or 5 to 1 risk reward trade with very, very minimal drawdown. If you entered here, you may have got a little bit of drawdown in this wick below, but generally speaking, you can see how just because a fair value gap gets filled doesn't mean that it's over. We can use the opposite. So if we had a bullish fair value gap and that was broken, that what previously was support, we can look to use as resistance. Might even be an example in here as well. So if I just replay that back to here, fair value gap in there, we'd look for that to be support. You can see it gets broken, and after it gets broken, you see that test there. We come and test it, and then the market sinks. So you can use that. Just go ahead now and try and spot some of those on sort of your favorite markets. It's a really powerful way to use fair value gaps. So there we have it. Everything you need to know about inverse fair value gaps is right there. Which do you prefer, using the traditional way or the alternate way? Let me know what you think in the comments, but either way, FVGs are one of the most fun ways to study smart money price action. And what I'll suggest now is going away and practicing spotting those inverse FVGs on a chart just like this. Thank you for watching, and if you'd like, feel free to subscribe to our YouTube channel, turn those notifications on so you do not miss out on the exciting new videos we are currently recording to show you. Trade well and see you soon.